Hey everyone, I want to do a video today, a little trading training on a Friday night, and give everybody a different look on how to read the market. So I'm going to type this in here, and we're going to call it. Let me just get a big. Let's see. We're going to call it shift in momentum. Okay, this is called shift in momentum. Essentially, the markets uh, look like this. Okay, and of course, this is a perfect picture. All right. That's a perfect picture. A lot of times you'll see a shift in momentum where the market has been going up and then shift down and then retrace and continue. A lot of times you'll see the markets have that move up, okay, go up, sharp, sharp spike down. Okay, so same thing with bottoms. Markets tend to shift in momentum. A lot of times you may see the market swing. Now, swing like this swing right here, a lot of times you'd like to see it longer. So let me explain. Market goes, it's on its way down, right? On its way down. A proper shift in momentum is when the swing up is greater than the swing down, and that sets up a trade. What does that mean? Well, if we take this high and this low, that has a distance, and that low and this high, there's a separate distance, right? So what we want to see is this swing up greater than this swing down. And typically, when you get that, that ends a swing and also shifts the momentum from going from down to up. Okay? And we're going to go through, and there's other little factors in this. So I'm going to go through as much as I could and show you some tricks that I use to identify when the market has stopped going in a direction and how you can apply this right away. All right? Right away. So let's take a look. All right? Perfect example. You see the market here, sharp was in a sharp down move, right? It's been going down and it tested below its prior lows. One thing you want to look at always is prior swing highs and prior swing lows. The test down here shifted the market from going down back up, okay? And then higher low. So you had that shift, that climax down. So what I mean by, let's just say you have a trend, right? Trend is going this way, it's nice, and all of a sudden you get this. Okay, what that means is this right here had a climactic moves. Trends tend to end in climaxes, all right? What the volume climaxes, okay? And that's basically what, that's just basic technical analysis that dates back for history, is trends tend to end climatically, where it's in an excess. So you also look at prior swing lows and prior swing highs. The fact that they snapped back up now says to you, wow, market found support down here, found support down here, has shifted back up, and that first retracement down, you want to look to buy it. Your risk goes here. All right. So depending on how many pips that is, all right, will determine your risk. Okay, and that equals pips, and you divide that and you add up your risk. So if you want to risk 3%, 4%, 5%, whatever it is on your account, you have to take the distance from here to here and you calculate it out in terms of risk. All right. So, but that's not the purpose of this video. The purpose of the video is to show you that looking at the end of swing and shifts in momentum, now typically that leads to a trendier type of environment. Let's continue to look and see what we find. All right. Here's another one. You see this shift. Market shifted going from up to down. You see that? Bounce, small retest. Fine. Okay, here, market shifted down, big move up. There's nothing you can do with that. Nothing. You don't want to chase the market up into the moon either. We have to be realistic about it. All right. And not every swing this is going to happen, but at least you'll have a tool in your belt to look at further opportunities in the future that you may not have seen in the past. Here is a perfect shift in momentum. This right here is a perfect shift in momentum. So let's take a look. Markets going down, and then that climactic move down, right? Ends the swing. Also, you can see there was major support down here, right? Then the market shifted back up, and this move up was greater than this move down. Then you're looking to buy that pullback, and your risk is down here. Okay? That's called a shift in momentum. That right there, that basically that turn right there shifts and says, okay, market has stopped going down, market wants to go up, and that first retracement down. What I like to do, okay, and that brings me to the next point. I like to look at Fibonacci. All right, I just like to look at Fibonacci. And if you look at some of my work on the videos, the academy, you can take a look at some of that. But a lot of times you'll get that 50 to 618 retracement. Even if it comes down a little bit further, that's okay. Your risk is down here. All right, your risk is always below. Now, what if here? Let's just take a look. Okay, let's just take a look and see how many pips are here. Okay, you got 35 pips. Okay, so if you're doing a mini lot, 35 bucks. If you have $1,000 in your account, hypothetically, you did a mini lot. That's 35 bucks. That's 3.5%. Keep it simple. All right. If you had 500 bucks in your account and you had 35 pips, all right, you do a half a mini. It's still 3.5%. However you want to adjust it, whether it's 5%, 2%, 1%, the fact is you look at these zones to pull back 50, 618. Sometimes you may even get a pullback as deep as a 786, but most of the time I like to see that 50 to 618. That's real nice. Okay, it's not perfect, it's not always going to happen, and then you always get that reaction back in your favor. Targets, okay, a couple of things I like to look at. Once the market shifts, nothing wrong with taking it out halfway back, a little piece here, and maybe trail it for a bigger move up. Okay, depending on how big your account size is, you put your initial buy is here, your initial stop is here, right below that. Doesn't matter, just a couple of pips. Market starts to move up. You lower your trade size and move your stop right below here. Okay. Market goes to new high. You take off more profits. Okay. The game is always being defensive. It's always getting smaller, always reducing size. You come in, you buy it, always reduce in size. Market moves up in your favor, you kick out partials, you reduce size. Up here, you can reduce size, you trail a stop. Okay, I'm not going to get into the details of the management on that, but basically that's the best way to play that game. So let's continue. So I want to show you that. Let me also add. Let me see if I can add an indicator. Of course, indicator MACD. So let's look at the MACD. All right. What I like to do is you got the colors. I make this blue and stop the video and slow it down. Or you can look at our videos on iMarkets Live Academy. All right. So I'm taking the MACD, I slide it over, I make the blue, red, and this is because I have the background of white. The first one is 3. This is 10. And this is 16. Okay. 3, 10, 16. Okay. And let's hit OK. All right. So just like I have it, exactly like I have it, you could look at it. So let's go back, if we could remember where it was. Okay, here it was, right? Okay. So there was something that my former business partner and mentor and had taught. Okay, the 310 oscillator, which was originally brought to the table by a gentleman. His name was Walter Brescher. All right, the gentleman's name was Walter Brescher, and he originally wrote the indicator in a book. Okay, let me see. This is chapter 13. Let me show you the book. You can research it on the internet. If it's out there, you can. That's what I did. The Power of Oscillator Cycle Combinations. All right, 13.1. Let me just show you. I just don't want to go past what I'm trying to get at, but I just want to show you, okay? Yeah, 13.1. 310 oscillator. All right, and he created this 310 oscillator back in the 80s, and Linda Raschke had made it popular. Okay, my former business partner mentor, and then we had used it for many, many years. One of the best things I've ever used was this 310 oscillator. All right, and on our website we have some education, and you'll always see all my charts have it. Okay, so it's a valid, valued indicator. So I showed you how to make it right here. So shift in momentum. Market shifts from down to up. Okay. And Linda came up with something called the first cross. Okay, the first cross. Great idea. Great idea. Market shifts from down to up, and the slow line goes above zero. So it's the first time the fast line goes below zero after the slow line has crossed above zero. So let's look at that again. Okay, I want to show you a trick, and you can look at this and play with it on your MetaTrader 4. So the fast line, the first time it crosses back below zero after the slow line has crossed above zero. That's called the first cross. And it tends to uh, coincide with the shift in momentum. Okay? Last swing up is greater than last swing down. That first pullback down, you like to buy on the buy side. Okay? And what we're doing is, like I said, we're looking at a Fibonacci. You just take your fib levels right there, and 50 to 618. It can go a little bit deeper, but it gives you a basis, a foundation where to buy. So if you look at this, when the market hit this area, the oscillator was nice down here, created that first cross scenario, and it gives you the opportunity to buy. So market went from overbought to oversold, and looking for that snapback. And typically you'll get that snapback up, snapback up. All right. I'm telling you right here, you can actually apply this the moment the market opens. You can start looking at this. I like to use the higher time frames. Hourly charts are perfect for this. You can use 30-minute, you can use 15-minute, but it's a very, very cool way to do things. All right, it's a really, really nice model, and you can see that shift in momentum going from down to up. Let's continue. All right, so markets go sideways. Now this is not a shift in momentum. That right here is a breakout. That's different, right? Market went sideways into a range, so market expanded, contracted, and then broke down. Not the same as the shift in momentum that we saw here. Okay, very different model. So this right here is not a shift in momentum. That's just a breakout. Now here we see the market had a climactic move down, shifted back up, right, and is given that shallow retracement. Big move up, shallow move, same thing. The first time, right, first time the fast line comes back below zero after the slow line has moved above. You see that? That's that first cross. Also, you got that shift. In this case, basically gave what they call a momentum high, and then that pullback, and it ties into this. Okay, it ties into that. That's another way to look at it. You know, you can look at pretty pictures on the internet, and everything looks so pretty until you really apply it. So I'm giving you some ideas to change your game a little bit. Okay, keep that in mind. So these are not shifts in momentum. This is all not. Okay, let's continue to see what else we got out there. And like I said, it's not going to happen all the time, but when it does, you're ready. Okay? Example. Market finished, shift in momentum, but it kept going. You can't do anything about that. You just have to leave it alone. Not a big deal. All right? Be real about it. Let's continue. Now, if you guys have learned and watched the videos we have on iMarkets Live Academy, you'll see that I always speak about the market going in waves, right? Elliott wave. Look up the Elliott wave video, all the harmonics, the market geometry. I always talk about Elliott wave, and the market moves in 5 waves: 0, 1, 2, 3, 4, 5, right? Always speak about it in my videos. So here, okay, here, if you look at it, the market went down, completed that 5th wave, shifted back up, and gave the retracement. That's a shift in momentum. That's something you want to buy on the pullback. You risk those down here. You also look at market made new momentum highs, gave the correction. The first time this corrected after the slow line has went above 0. Sets up the buying opportunity. Risk down here. Now, this may be 38, 50, 618. I like to look at that 38 to, or even 50 to 618. I like to look at that zone and put my risk under here. All right, if you see that the market's stalling and your oscillator's correcting, or you see prices holding, you have to be real and say, you know what? Maybe you'll put a little piece of the trade on. Maybe instead of a 1 minute, you put like 3 or 4 micros, You have to be flexible as a trader. You don't just sit and wait, okay? You got to be flexible as a trader. If you were to get maybe a third of a position on and the market goes up, you win. If you get a third of a position, a third, and a third, that's fine also. At least you understand where your zone is to trade and where it should and should not go. You're good. You could be very successful, with trading and putting in and taking off positions. Okay, let's take a look at another one. All right. So I don't. I see right here. Market shifted from here. Market shifted straight down. Gave a nice reaction back. All right. So this right here. This went up, came back, up, came back, up again. So we see that it had multiple tests up here. It failed, shifted, going from up to down, that first retracement up. And once again, the first time the oscillator goes above 0 after the slow line went below. And you get that shift in momentum, that retracement. Risk is up here. So let's take a look. Let's take a look. 60 pips. All right, so that falls into the category of what we were just looking at, right? Move down was greater than the last move up. You have that failed action up here. Swing down, swing back up, coming into your zone. And also you have that slow line went down. Is the first time the fast line went up above 0 after the slow line came down. And you have that. Shift in momentum. One more time. Let's take a look. Market went down and all of a sudden you had that shift back up and that retracement. Okay? You didn't get the real pullback on the oscillator and now the market's expanding. So what I tried to do is give you a good, clean idea on how to use shift in momentum, how to set up your MACD, how to understand and read price, all right, and give you something that you can apply right away when the market opens on Sunday night. You're welcome to share this video. You're welcome to share this video and help your team and friends if anybody has any ideas on what they're looking for. And yes, this is a demo account I use for my analysis. Actually, I use it for our different products. We have so many different things we're working on. I got stuff for market profile we're bringing to the table, and GAN work that we're bringing to the table. We have our harmonic scanner. We have a lot of things that I'm bringing to the table. For example, I'll give you a little insight. Okay, this is called market profile. Okay, and as markets create consolidation, it creates what they call a profile or a balance area. Okay, that point of control, that little balance area. And a lot of times you'll see this and you don't know when to buy. What we like to do is as the market's pushing below that balance area, that belly, we like to buy into it. All right. Something I'm going to come out in the future. We're working on all the coding now, and something we're going to teach later on. But we have a little bit on the website in the back office. But regardless, my name is Christopher Terry. I hope this video helped you, and enjoy your week.